Hello, America. I'm Camille Chandler, and this is Qualitative Listening. Today's subject: take advantage of the current market stability and purchase corporate bonds. We'll get more into that, but as always, let's go over the yield curve. The 3 month is at 4.32%. The 6 month is at 4.24%. The 2 year is at 3.85%. The 5 year is at 3.96%. The popular 10 year is at 4.36%. And the 30 year is at 4.85%. This configuration indicates a modestly inverted yield curve where shorter term yields are higher than some longer term yields. Such an inversion often signals investor concerns about future economic growth. The market's cautious stance is further underscored by investors' preference for shorter duration assets ahead of the Federal Reserve's upcoming policy meeting. This approach reflects apprehensions about potential policy shifts and economic volatility stemming from recent trade developments and inflationary pressures. In today's news, bankers are advising U.S. companies to take advantage of temporary market stability created by a 90-day pause in tariff escalation to issue new debt. This window is seen as an opportunity before potential volatility returns. So we'll go over what are corporate bonds. Corporate bonds refers to the process by which a company raises money by selling bonds to investors. Here's how it works in simple terms. The company needs capital. A business may want to raise money for expansion, operations, and refinancing owed debt or acquisitions. It issues bonds. Instead of borrowing from a bank, the company issues bonds, essentially IOUs, promising to repay investors on a specific date, the maturity, with periodic interest payments, coupon payments. Investors buy the bond. Institutional investors and individuals can purchase these bonds. The company receives the money up front and agrees to the repayment terms. Why it matters? Corporate bonds are a major part of the bond market. The level of issuance can reflect business confidence, market conditions, or the appeal of interest rates at the time. Examples of corporate bonds include Apple, Tesla, Amazon, and Coke. Corporate bonds are less volatile than stocks. Let me explain why. Why corporate bonds are typically less volatile? Fixed income. Bonds pay regular interest coupons, providing steady income and reducing price swings. Priority in bankruptcy. Bondholders get paid before stockholders if a company fails, making bonds less risky. Defined maturity. Bonds have a set maturity date so investors know when they'll be repaid. When bonds can be more volatile, high yield bonds. These are riskier or more sensitive to economic conditions, more like stocks and behavior. Interest rate sensitivity. When interest rates rise, bond prices fall. Long-term bonds are especially vulnerable. Credit risk changes. If a company's financial health deteriorates, its bond prices can drop sharply. Alright, that's all I have for you folks. As always, thanks for listening to Qualitative Listening.